Okay, good morning guys. I hope you're all well. Welcome to the final week of January, and we are on the back foot, that is for sure. And not surprisingly, we've kind of been expecting this, but I've got some charts here for you, just looking at daily views of different assets. We've got the S&P equity market top left, we've got the euro against the dollar top right. Bottom left, we've got the German Bund, 10-year government bond, and then bottom right, gold. So 4 different assets here, and it's quite interesting to see how these are shaping up. I mean, looking on this view, looking on the daily chart, okay, yes, we had a massive sell-off on stocks on Friday, and I'll come to that in a minute. And yes, we've broken the downward trend line, but if you're going back to, let's say, September, we're still, impressive gains. Despite that big sell-off at the end of last week, we've still got impressive gains over the last few months. You'd say euro-dollar's been flat, a touch of upside perhaps, but generally flat. You'd say the Bund has been flat, but actually a really decent bullish start to the year. And on Friday, we broke up and made the highest levels traded since back at the start of August. And then gold, downtrend, but now bounce. So gold particularly enjoying a good start to the year. So what we've definitely had in 2014 is very strong performance in bond markets, safe haven bond markets, particularly Thursday and Friday, really propelling higher. But actually bond markets generally, even peripheral bond markets, done very well this year. Gold's had a really good start to the year. So perhaps the more safe haven type assets really benefiting at the end of last week. So let's just zoom in. I'm just going to bring this S&P chart a little bigger, and let's discuss at the end of last week what happened, because this was the biggest down day, well, since the summer of 2013 here. So the S&P collapsing 2.3%. Much bigger down days in other stock indexes, like, for example, the Euro stocks were down 3.46% on Friday. Big collapse. Technically, this is now looking very, very negative. We've breached this upward trend line. We smashed through the very important 1812.50. We broke down through 1800. Just kept on going. It was quite extraordinary, the scale of the downside we got on Friday. And so far today, it's been quite tight, but nothing other than a tight consolidation of the massive sell-off. There's, as it stands, not much appetite to reclaim this big sell-off. So what's the driving force? And it's a culmination of things. It tends to be when you get a big move like this. It has to be several factors normally, and it's a general sense of nervousness. And the emerging market space perhaps triggered this movement at the end of last week, with some of the emerging market countries that are carrying current account deficits, the likes of Turkey and Brazil and South Africa, for example, really suffering. But perhaps it was the Argentinian peso collapse that triggered it all. But really this just forced traders into making decisions that they'd been considering for a while, because really what we've got here at the start of this year now is a fairly weak, well, in my opinion, a fairly weak earnings season so far in the US. We've had one single bad non-farm payrolls number, and the problem is that nobody thinks this is going to alter the Fed's mind, because this week, on Wednesday, one of the big events of the week is the FOMC meeting, Bernanke's final meeting before Yellen takes over, and they're expected to go again. They're expected to taper by another 10 billion, and despite the fact earnings season has been a bit lackluster, despite the fact we've had a bad payrolls number, everybody thinks tapering's continuing, me included. And so what this means for emerging markets is you've got a potential very negative double whammy, because potentially you've got this idea that the developed market economic growth story perhaps might be just faltering here a little bit, and yet at the same time, so clearly that's bad for emerging markets. Demand from developed markets is what it's all about, of course. So if that demand from developed markets isn't going to grow quite as bullishly as we had thought a few weeks back, well, that's clearly bad news. But then at the same time, you've got the Fed continuing with their tapering process, which which is also bad news because the tapering process is really just sucking funds out of the emerging market space, that foreign direct investment that emerging markets are so reliant on is in reverse at the moment. And so we've had dramatic movement across the emerging market space. The Turkish lira is really heading the story there. But, you know, you've had broad-based sell-off across the world. It's not just emerging markets that are getting damaged. Here's the S&P with its biggest sell-off for over 6 months. So we've got negative sentiment. We've now got very negative technical pictures. And we'd expect as we go through this week, this bearishness to continue. Now, the key target for the S&P, 1754.25, or sorry, 1754, bang on. That was the December low, mid-December. We certainly expect to move down to there. It's only another 30 or so points. And I would be very surprised if we didn't see that level this week. And let me just show you on a percentage basis. If we did get down to that level, you're looking at, well, it's exactly a 5% sell-off. That would be exactly a 5% correction from the top that was set at the start of the year. So that would be quite nice and neat. And a 5% correction, let's be honest, is nothing. That's absolutely fine. And indeed, when we get to 5% correction, as we think we will, I think there may be grounds for even more downside. We'll see when we get there, but and it depends how long it's going to take, and perhaps if news flow turns or not, or if emerging market currencies can stabilize or not. But for now, we remain very bearish, and we expect these markets, generally equity markets, to suffer this week. If I just scale this back up. You've got gold. We've been quite bullish on gold this year, and it's certainly been the right view. A very messy upward trend line here. It's not. It's by no means a good channel. It's just a general guide. I might even move that to maybe there. But anyway, you get my point. The point being that we've had generally upside this year, and it's about 5% up on the year. And importantly, on Friday, on Thursday, gold topped out bang on this December high at 1266. It was Friday that then we broke above it. Although closed back below it in a perfect doji for Friday's session. But this morning we've gone again, and so properly broken up through 1266, in which case the next sort of barrier on the upside would be in the 1290s, if not the 1300 handle. Okay, so gold's benefiting from safe haven flows. Despite the fact inflation conditions remain pretty subdued, gold is still able to benefit, and we had strong news, well, potentially good news from India from a policy point of view on imports, which may well help the gold price as well. So gold's certainly benefiting. The other factor to add into the mix, on top of this idea that we've perhaps got a little bit of a drop in momentum in the developed world, added to the fact that we've got a weak earnings season, added to the fact that we've got tapering almost certainly going to continue. At the same time, there are risks and concerns about China, and here's the Chinese GDP chart. And the risk is that it's the belief that China and the Chinese government are continuing to try and achieve a growth rate that's too high. So last year in 2013, they had a GDP target of 7.5%. Now, to achieve that, they really had to pump in some funding in the summer of last year. They unwound a decent-sized stimulus program in order to meet that 7.5% target. Now, if they continue to do this, if they continue to pump stimulus in just to achieve certain targets, there is a school of thought that says that this artificially fueled growth, ultimately, you know, the longer they pursue that, the bigger the blow up will be, the bigger the asset bubbles will be when we come, you know, when everything falls over. But I think that's a very pessimistic, sort of alarmist view. But I think there's something in that, and you know, I think we are going to have to see Chinese growth dip to 7% to 6.5% in the years, you know, in the next 1, 2, 3 years, and the sooner the world is comfortable with Chinese growth rate below 7%, the better, because then China don't have to continue to artificially stimulate to achieve these targets. Importantly, this year, China have not put forward a growth target. This is very unusual. They always have a growth target for the year. This year they've decided not to go with one, so maybe this is a signal that they're going to allow things to perhaps find a more sustainable base, lower than where we're trading at the moment. So this is also adding into the mix of negative sentiment. So we've really got a culmination of factors driving this risk-off movement. So it should be a pretty interesting week, guys.